Welcome. Thank you so much for joining us today for our weekly webinar. My name is Alicia Race. I'm a partner here at Fourlane, and I'm excited today to talk to you about financial ratios. Hopefully next week we're getting into QuickBooks. This is my last kind of CFO series that I'm going to be going through. So hopefully I am teaching everyone a little bit of something. All right. If you missed any of our previous videos, you can always find them on our Fourlane YouTube channel, which is youtube.com/Fourlane. Remember to subscribe. That way you can get notified when new videos come out. You can be the first to see them. You can also connect to us via our Fourlane Facebook group, which is Fourlane QuickBooks Enterprise. You can't only connect to us, but you can also connect to your peers, kind of hear what's going on. There's always something being posted out there. So it's a definitely good thing, good group to be on. All right. Fourlane on-demand support. So as always, I want to mention our Fourlane on-demand support service that we offer to our clients. This service is only $25 per QuickBooks user per month for up to 5 users. After that, it drops to $20 per month per user for 6 or more users. So it kind of shows you on our screen a little bit of the things that we cover on here, but you know, I want to tell you a little story about one of my friends that called American Airlines this week, called customer service, and the recording said their wait time was 70 minutes. Of course, I mean, being me, I started laughing and was like, seriously, you're not going to stay on hold for 70 minutes. And they didn't, they hung up. But, you know, that's exactly the reason why we wanted to offer an alternative solution to our customers, right? Nobody wants to sit on hold. We all are very busy. We've all got stuff going on. And so this is an alternative solution to calling any of the other, you know, support services. You can call us directly. You can have access to any one of our consultants, our experts directly, and then we will be able to hopefully resolve your issues. If not, we'll be able to provide you with a solution. It's one of our core values here. Okay, so today, what are we gonna talk about? So last week, we talked about reading financial statements and, you know, kind of where things are on those financial statements, right? So I want to today talk about financial ratios that we're going to calculate based off of the financial statements that we went over last week. There's a lot of different ratios that we can calculate. So in preparing for the webinar, I have probably thrown in too many ratios to talk about. Maybe I've removed too many. So I'm going to try to show you as much as I can today. I wanted to point out some really important ones that I thought a lot of my clients definitely, you know, have asked me about in the past, and so I think it would be very beneficial to share with you today. You know, we use most of the ratios that I'm going to present to you and go over today. Basically, we use them in our file review. So the file review allows for us to kind of look at a client's file, go through the list information and financial reports. We dedicate an entire section in our file review to these ratios. And so that kind of hopefully just tells you how important that we think ratios are. if we wouldn't have an entire page dedicated to it, right? If it wasn't important. Okay, so I want to start off our conversation and remind everyone of these 5 types of financial ratios. So I'm not sure, 3 weeks ago we had, if everyone was in attendance, but we had CFO services, and I talked about financial ratios then. And so I want to go over them. The first one is liquidity ratios. So what is this? It's a way to assess the firm's ability to meet its short-term obligations using short-term assets. It's a lot of words, but what I want everyone to know out of this is basically, you know, this is a rolling number each month, right? So every month we're going to have a 12-month rolling kind of obligation. So it is really short-term obligations using short-term assets. Asset management. What is this? So this is also known as efficiency ratios. This indicates the efficiency of use of assets and generating sales. So it is important. There's 5 different important efficiency ratios that I want to make sure that we can cover. May have to skip 1 or 2 today, but we will get through what we can. Our average collection period. This is important. I think I've had quite a few of my customers ask about, the collection period, and so we'll go through that. Inventory turnover. If anyone on this call uses inventory, this ratio is really important to be able to calculate. Cash conversion cycle. We've got our fixed assets ratio, and then our total assets turnover. So these are some of the ratios that, again, under the asset management that I think is very important. Our leverage ratio. So this is also called debt management ratios. You measure 2 key aspects of debt financing by your company or the firm, right? So the use of debt financing is called financial leverage. That's why it's under the leverage ratio. So when we calculate this, we want to know the level of financial leverage used by the business, as well as the ability of the company to service its debt obligations. Okay. So how well can I cover all of my obligations? And obligations also known as liabilities. Profitability. I know some people on this call may say, I really don't like hearing all these financial terms, but again, hopefully after these 3 webinars, you'll be able to really gain some understanding of why they're so important. So profitability ratios. These are also known as performance ratios, right? If we're not performing, our profitability is not going to be great. So what is this? It's a way for the company to understand its ability to earn profits on sales, assets, and equity, right? These are very critical in determining how attractive a company is, right? How attractive it is, or how attractive a company looks for investors, right? It's one of the most used ratios by investors. Okay, there's 5 important profitability ratios. We've got gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. Okay. Valuation ratio. The valuation ratio indicates market valuation, right, of stocks in terms of some measure of company fundamentals, such as earnings, potential book value, cash flows, and dividends. This valuation ratio, it's really used by primarily used by public companies. So a lot of us may not be using these, but a lot of us may be. So these really change, these ratios really will make a significant change as the stock market changes or your price of your stock changes. And so that's where these really become valuable and important. Okay, so I probably won't get to these today, but I definitely wanted to make sure that I covered them because it is important. It is part of what are 5 types of financial ratios. And so we for sure want to not miss any of them. All right, so I want to go into QuickBooks. And I want to start off with our current ratio. So I went into basically the company financial and report section, and I'm just going to use my standard canned report. Okay. For our current ratio, it's easier to look at this at the balance sheet summary report because it's much smaller. I actually exported this, so hopefully everyone can see it much easier. So our current ratio, our formula here is total current assets divided by total current liabilities. Okay, so I've highlighted here our total current assets, my total current liabilities, and when I divide these, I get 2.37. So what does this even tell me, right? So this ratio is going to indicate the extent to which our current liabilities can be paid off through current assets. So if a company can meet their short-term obligations is another way of looking at it. What would be a good number? Well, this indication right here, right, if we kind of put it into perspective, I guess. So if we had a calculation that resulted in less than 1, right, we basically would want to figure out how to get back into a positive or +1. But basically, one of the ways that we could improve this would be collecting sooner, invoicing sooner, right? Trying to pay off our liabilities, any of the obligations that we have. Okay, so if our total liabilities, current liabilities, are greater than our current assets, we would be less than 1, right? We would need to kind of look at some ways to get some of those liabilities paid off and reduced. Another one that I put together for us, quick asset ratio. See if I can blow this up so that everyone can see it. So our quick asset ratio is going to be our current assets less our inventory. Okay. We want to remove any liquid assets from our current assets because they're going to skew our numbers. Okay, so that's the reason why we're getting rid of the inventory dollar amount from our current assets. And then we're going to divide it by our current liabilities. So I've highlighted here our total inventory, total current assets. And then down here, my total current liabilities. Okay, so those are where my numbers are coming from. So I take this and I go ahead and I plug this into my formula. So my total current assets, the 355, I'm going to subtract out the total inventory so my numbers are not skewed. And then I'm going to divide that by 149,896 to get 1.8. And that is going to be my quick asset ratio. So this ratio is going to tell us, right, how fast we can pay off things through our current assets, meaning our cash. So if we come over here, part of our total current assets is going to be our cash. Our accounts receivable, if we collect that. If we go collect our deposits and we ask for those back, right? So these are things that we will be able to it's a quick asset ratio. How do I pay off those liabilities? How to get all that done, okay? And I also just want to remind you that just because I'm showing you calculations today, manual calculations, that does not mean this is the only way that you can get these calculations, okay? So I do want to go back and just show you really fast that under reports, we've got advanced reporting. This is what is called QuickBooks Advanced Reporting. Some of you may know this as QBAR. QBAR is a way for us to build into the system, right? Build in things that would take two numbers together, like I've been showing you in Excel, and getting these ratios together, right? So all we have to do is run that report. So I want to just make sure I remind everybody that you don't have to manually do this. We offer the advanced reporting. We can build that report for you. We have a QBAR expert on staff. So if you're cringing, there's alternatives. Okay. I want to go show you some other ratios that I put together. So this is our average collection period. Okay. What is this? So this is our receivables divided by our annual credit sales divided by how many days are in the year, 365 days, right? So one way to calculate this and even to figure out what this means, right? So this is also known as, and what some people may understand this better, but days of sales outstanding, right? So either one of these ratios or ratio terms are the same, right? Either one is correct. But how long does it take for us to collect our money? And this is really important, right? We know if we are going to give people the ability to have an account, a credit account, right? They can charge it basically. What is our average collection period, right? So I'm going to take my total receivables. Then I'm going to take on my profit and loss. Let me go into QuickBooks real fast and show you how to get there. Reports, company and financials, and I just did my profit and loss. I customized this report to show this fiscal year in a sample file. We're in 2026. I know it's not 2026 currently. And then once I do my dates this fiscal year, I'm going to display columns by month because potentially I want to see over month, okay? And then I exported this to Excel. quick and easy export. And so now going back to our calculation, we've got our total sales. Okay, so I am going to take my Excel, bring back my total. Let me just copy and paste. Probably would be easier. Okay, so there's my total sales. Take my beginning AR, and I'm going to take my ending AR. This is the easy way to calculate, in my opinion. I'm going to add these two together and divide this by 2. Okay. So now I'm going to take my receivables, my average receivables, my sales divided by 365. Right. So I'm going to take this and divide it by 365. Here's my number up here. I'm going to get this out of the way. Divided by this. Okay. 56 days. We could make sure we're rounding up or down, but 56 days for us to collect our receivables, to get cash. That's pretty significant information for a company, depending on, you know, their cash in the bank, right? If you're trying to figure out when that next payment's going to come in. So this is really important. Okay. Let's take a look at our inventory. And let me see if I can go to our inventory stock turnover calculation here. So this is, I better hurry. So this is where we are going to calculate our cost of goods sold divided by our average inventory. Okay. So my cost of goods sold is going to be on my P&L. And if you were on that webinar, the P&L, like Austin, that has lots of different names. It can be called the income statement, the P&L, the profit and loss. Okay, so it is here, our total cost of goods sold. And our total cost of goods sold is everything it takes for me to sell my product or manufacture my product, right? So we've got 325,000, and I'm going to do our average inventory, which I already did here. Okay, so I just took my inventory from my P&L and I took the average. Okay, I'm going to divide these two. Cost of goods sold divided by my average inventory. So the inventory turnover indicates whether inventory levels are reasonable in relation to our cost of goods sold, right? Our lower inventory turnover ratio based off of our industry standard may indicate either obsolete inventory, super slow moving inventory. Higher turnover may indicate that our inventory is possibly, we've got shortages. Maybe we have inadequate inventory. Monitoring my time and I am running out. Okay, so I hope that this inventory, or our, if you want to call it stock turnover ratio, has been helpful. I'm going to try to just go over these total assets, total asset turnover. So our total asset turnover, this measures the efficiency of our use of total assets and generating cells. So our cells divided by our average total assets, very similar to how I did the inventory calculation. You would get your total assets and our total cells number, and we would do that calculation. It's a simple average of total assets at the beginning and at the end of the period. Okay, I know I am right coming up to time. I hope that everyone can join us next week. I really appreciate everyone joining us. I hope that these formulas and these ratios were beneficial, showing you how to get those. And next week, we are going to talk about virtual warehouses, and we're going to truly be in QuickBooks. I'm excited to talk to y'all about that. And again, thank you so much for joining us today. I hope you have a wonderful rest of your week.